Welcome to today's webinar, Save Taxes in 2022. There's still time, and we're going to show you how to do it. My name is Alicia Hicks, and I am your moderator today. The information in today's webinar is hosted by American Wealth Strategists. I want to introduce you to Mike Miller. Mike is the Director of Operations at American Wealth Strategist, and he has many years of business experience and knowledge. Mike directs a team of tax and legal experts. He brings a client experience that's unmatched in the family office industry today. Mike, saving taxes, doing taxes are always top of mind. We're really looking forward to what you have to share with us today.
Well, thank you, Alicia, for that introduction. Yeah, I mean, it's on everybody's mind, especially if you're this time of year with taxes being due. Well, good afternoon, everyone. It's wonderful to be with you and share some really important information. Our purpose in today's webinar is to give you 3 different examples of how we've helped clients reposition and take advantage of the long-term effects of divorcing the IRS from their investment and wealth preservation plans. American Wealth Strategist is a multifamily office, and we assist business owners, investors, and other professionals through our team of tax, legal, financial planning, and wealth management and insurance specialists. Our clients consist of a wide variety of successful individuals and their families from all types of walks of life, which have all different types of net worth. As a registered investment advisor solicitor, we and our strategic partners are fully licensed for tax, legal, insurance, and securities. We have a special niche in tax strategy, which we use to complement what we call a proactive estate planning model to help protect our clients from unnecessary taxes and help dramatically accelerate their wealth financial results. We do this with a coordinated effort of working with existing clients' advisors to help accelerate the client's objectives. Now, the problem we're facing is really a 3-pronged attack on your wealth. Those are taxes, inflation, and political uncertainty. Taxes are the single biggest expense that anyone faces in their lifetime. You are taxed on every single dollar you make. Then again, once you spend it, the government is now aggressively coming after every single tax-deferred vehicle like IRAs and Roths to further squeeze more money out of families. We have never seen inflationary pressure like we are right now. According to FinTech Technology News, in May of 2021, 40% of all U.S. dollars in existence were printed in the last 12 months. Think about the enormous increase in the circulation of money. Now, who cares? You may ask. Well, it leads to inflation and devaluation, which leads to recession. And finally, political uncertainty. The rhetoric out of Washington is flat out scary, and with the new assault on wealth. Taxes are already burdensome enough, and it could become worse with our current congressional proposals. Secretary of the Treasury, Janet Yellen, has said that taxes on unrealized gains is something the government is taking a very hard look at. That would tax assets that you aren't even selling yet. Can you imagine being taxed on money that doesn't even exist yet? Well, that's what this administration is proposing. There are 4 main reasons our clients come when looking for answers. How do I control my taxes? How can I create more never taxed versus always taxed investments? How can I really create generational wealth and protect it from changes? And I need to coordinate these efforts. I need answers, and I need my advisors to work as a team. How do I do that? Well, we're going to answer all these questions today as we walk through how we help 3 different clients. Now, I'm going to jump right into the case studies because I know that's why you're here. The first case study is an illustration of the solutions in action on a relatively small problem. We did this on purpose so you can understand the general idea before we move on to more complex examples involving even more money. When Robert came to us, his main goal was to use the rental income he was getting to set up a legacy for his kids and build wealth. Robert was getting $150,000 a year after expenses and wanted some options to reduce his overall tax liability and build wealth. Robert and his wife both have corporate jobs, so they don't need this $150,000 in rental income to cash flow their lifestyle. The income from this rental property flowed into his personal income, and that created a couple of problems. First problem is that all of the income was subject to taxes. The second problem was the additional income was bumping he and his wife up to the next tax bracket, and that caused them to pay a larger tax bill. So with our tax and legal team, we created a limited partnership to own the LLC that contained the rental property and made a trust as a limited partner. So now the $150,000 a year flows into the limited partnership, which Robert can distribute to the trust. This dollar amount reduction from his taxable income dropped Robert and his wife from a 35% tax bracket to a 24% tax bracket. It also created an account that he and his wife were able to use as a family bank. From there, it can grow and compound tax deferred and finance all of the expenses of his beneficiaries, in this case, his children. Now let's look at a case involving much more money. Here's an example of Carl, one of our very good clients that does a lot of residential and commercial real estate investing. He has a successful day trading business, and he gained this day trading experience from his hedge funds days. So this is an example of a client making over $1 million a year. Now, Carl is a divorced father of 3 boys, and projecting his current income through the end of the year, his taxable income in 2022 would be about $1.4 million. Now, this would create a federal tax liability of just under $500,000. Now, Carl's primary reason for coming to us in the first place was that he wanted to protect his assets, his nest egg, and then he wanted to create wealth that he could pass on for generations. Through our strategy sessions, one of the things that Carl mentioned was that he was tired of adjusting every year for tax changes, and he wanted to do something proactive so that he could avoid the uncertainty of future tax law changes and the political environment. And Carl realized that the way he was structured corporately, all of the income flowing directly to him, and he also was well aware that in the real estate business that he could be a target for a lawsuit. And the way he was structured meant that all the risk flowed right straight to him. So Carl has tried many ways to minimize his tax liability. And other than being told to find more deductions, there was just no way with his current corporate structure to do any type of tax mitigation strategy. And Carl knew that he was in the highest tax bracket and that he was being targeted with the new legislation with these wealth tax. So through our strategy sessions, Carl and our tax and legal team got a good grasp on what he wanted to do, what goals he had, and what type of outcomes he wanted. So the tax and legal team created a limited partnership for Carl. Carl was a limited partner along with a few other partners he had in some other corporate entities. And we also made a trust as a limited partner. Working with our tax and legal team, Carl determined that his lifestyle and retirement planning would cost him a couple of $100,000 a year. This allowed him to distribute to the trust nearly $1.2 million. Now, this reduced his tax liability from the 37 to the 32% tax bracket. It reduced his potential tax liability from $487,000 to just $64,000. Now, over the years, distributing this income to the trust will allow Carl to defer 100% tax liability on these funds and create a family bank for business and investing purposes. It also gave him the ability to pay for his children's lifestyle, medical, education, and maintenance from the trust with pre-tax dollars. So that winds it up for our second case study. Now I want to show you an example of one of our higher income earners. Nicole is really a true success story. She seemed destined to be successful, one of those entrepreneurs that everything she touches turned to gold. And she was referred to us by one of our CPA partners. And when Nicole first came to us, she had just lost a big chunk of her net worth in a divorce. She had already become disillusioned with her current advisors because of her tax bill just kept increasing year after year. She felt completely exposed not only to the taxation, but to the liability from the decisions that she had been making. Now, Nicole was determined to find a way to make up for the financial loss she experienced from this divorce. She wanted a coordinated effort between the legal, tax, and investment team to aggressively increase her savings and investments. She came to us early enough in the year that we were able to analyze her taxable income for 2022, and we estimated that that would be about $4.3 million. This would have created a federal tax liability of nearly $1.6 million. But the results of the strategy sessions with Nicole really emphasized the point that all of the income and liability from nearly a dozen corporate entities passed straight to her personally. And discussion about retirement scenarios, Nicole wanted to emphasize the creation of a retirement plan that had an emphasis and a focus on tax-free income. And while she wanted to increase her savings and investments, Nicole wanted some things put in place to protect her from future relationship issues and didn't want to use prenup agreements. She just thought that set a bad tone at the beginning of a relationship. So here's the solution that our tax and legal team came up with our wealth management partners for Nicole. By setting up a limited partnership to own the revenue from all the corporate entities and with a trust as a limited partner, we set up 3 buckets of money for Nicole. Nicole wanted to set up enough money for her lifestyle and determined that would be $400,000 annually. So this is an amount that Nicole would have distributed from her corporate entities to herself, and it had been fully taxable. Inside the trust, there was 2 specific buckets of money. One bucket would allow her to pay 100% of her children's expenses related to lifestyle, medical, educational, and maintenance with pre-tax dollars. The other bucket in the trust account was designated for investments. Now, while there's no limit on the type of investment that can be made from these funds, Nicole planned to use our wealth managers to invest the money. The overall result was that our tax and legal team was able to reduce Nicole's federal tax liability from $1.6 million to only $140,000. Now, that winds it up for our last case study. And if Nicole's situation resembles yours, we just need to have a conversation, discover your situation, and go from there. So before I get into some qualifying factors and timeframes, let me answer a few questions that people have asked from our previous webinars. First question is, especially at this time of year, do I really have time to do tax planning this late in the year? And the short answer is yes, there's still time, but it's quickly running out. Really, the first week of December is pretty much the last week that we have that we can help people with tax strategies to minimize taxes for 2022 income. The process involves working with our tax and legal team to develop the strategy for you. Getting corporate entities set up with the state of Texas can take some time, and getting all the banking set up takes work. Another question we get is, are there restrictions or qualifications for these tax strategies? Yes, there are qualifications. Some of it relates to the type of income that is used to defer taxes. And there are restrictions about why these strategies are established and who can utilize the strategies. There must be other economic and family dynamics in play, not just the desire to reduce income. And a lot of questions that we have from our last webinar is, have these tax strategies held up in IRS audits? And a good question. No one wants to get jammed up with the IRS. The answer is yes, and there's plenty of case law that applies to these strategies. None of our clients that have had these strategies have ever failed an IRS audit. Now, there's no secret sauce to these strategies. If there is a secret sauce, it's what we do to help our clients stay in compliance with the IRS code in the operation of these corporate entities and trust. We found that these structures work best for individuals who have taxable income. That's line 15 on your 1040 tax return, is at least $750,000, or their tax liability is at least $100,000. If this sounds like your situation, then we need to talk. We still have time in 2022 to make these kinds of dramatic reductions in your tax liability, but time is running out. It takes time to set up the corporate entities with the state of Texas and create the trust. These bank accounts have to be set up, and money has to move around in these bank accounts before the end of the year. Now, if your income or tax liabilities aren't that high yet, we can help you get there with other strategies. And just in case nothing we present today impacts you, keep in mind that we work with clients in retirement planning, business exit strategies, corporate tax mitigation strategies. And this concludes what I have to share with you today. But everything begins with a conversation. And I'm personally looking forward to having that conversation with each and every one of you. So what you need to do is book a time to call. And regardless of anything, the existing taxes are something that you shouldn't have to subject yourself to if you can avoid it. Give us a call, book a time to talk with us, and we'll be happy to help you. So for me, Mike Miller, and everyone here at American Wealth Strategists, we hope you have a good day. Thanks.